I was wrong about high yield ETFs. 100%, not a little bit, completely, fundamentally wrong. For 2 years, I ran an income portfolio that generated monthly distributions, 40-50% yields, and I thought I cracked the code. I thought this was going to make me financially free, just like a lot of other investors. I thought this was the way to go. In a couple of years, we would be pulling money out our portfolios and putting our feet up. But things have changed, and today my portfolio is now 100% momentum growth. I have 67 convicted, concentrated positions in my portfolio, and I use a systematic framework approach towards my portfolio now. So a lot of things have changed, and I've also been to the Think Academy for my education on the momentum based approach, and it has excelled my portfolio in a lot of ways. So within that time frame of switching from income to growth, I have hit quite a lot of milestones in my portfolio. For a start, the portfolio has hit 250k, which was my year-end 2026 target. So like 6 to 7 months early, I have hit my targets, which is absolutely amazing. I've actually spent some of the money I would usually invest on taking my family on holiday instead because I've hit my target so early. I've hit over £50,000 in profit alone this year, and I've bet the S&P by 20% year to date. So this approach from the Think Academy is clearly working. I have not used everything from the Think Academy. I have took some of the steps into my own framework. So this is going to be the story of what I got wrong, what I got right from being wrong, and despite everything I've just said about high yield ETFs, I still own one of them. So if you're chasing yields or you're chasing high distributions, this video is probably going to be for you. So let's take it back to 2 years ago then. I was obsessed with cash flow, obsessed with distributions, dividends hitting the account. Absolutely loved it. The idea of dividends hitting my ISA tax-free, it was intoxicating. And when YieldMax and income shares came over to Europe, it just felt like the perfect timing. It felt like everything that we'd been waiting for because we couldn't get access. And there was a lot of hype around them. I'm going to be honest, I think we fell for the hype. Especially I did. So for any of you who was around back then, my portfolio was 100% high yield ETFs and income products. Yes, I did have some lower income products, but there was 0% growth in there. And this was the main problem to start with. But saying all that, one thing you can rely on option-based ETFs is distributions hitting monthly. They landed like clockwork. And to be honest, I thought I'd found the perfect vehicle. Here's a couple of things I was telling myself. Why work for money when I can make money work for me? Let's just compound the distributions, get rich slowly, and retire fast. That's what I thought. And how wrong was I? And I kept saying growth is just for people who don't understand income. I said the maths work if you just reinvest everything, which it does. But what about when you want to start taking the distributions as income? That is when you have a problem, when you've got 100% income portfolio. So I was 100% income focused, no individual companies, no businesses, no conviction. So for a while it looked like it was working, and the distributions came in, the cash flow was coming in, and everything looked good for a while. But we was in a bull market, and these weren't great in a bull market. If you want distributions, but the problem is, when the markets get a bit flat, get a bit rocky, we're having that zigzag motion up and down, these ETFs get wrecked. And that is the worst thing for an options-based ETF. So here's what I was actually missing, is the way that compounding works. So the compounding maths never worked the way I thought it was gonna. The main problem I see is people look at yield and don't look at total return when they look at these products. And the issue is a lot of these high distributions come as return of capital. And as we know, the net asset value drops quite a lot. And don't get me wrong, some of these products work great. Some of them, I'd say 75, 80% of them don't. But the problem is, even the sustainable ETFs, a lot of them can't compound at the same rate as what growth can. And this is something that I thought I didn't want, I thought I didn't need. But one of the biggest mistakes I've made so far is misunderstanding time and what my age can do. I was 30 years old at the time, and that is my biggest asset. My biggest asset is time. So I have time to compound my wealth. So I was 30 years old and I've got another 30 years to compound, and I'm using a vehicle that distribution doesn't grow or compound. So that is absolutely stupid. That is by far my biggest mistake. And on top of that, I had no framework, I had no rules, no entry, no exit. It would just buy and compound the distributions, which, all in fairness, when the markets are choppy, the NAV goes down, your distributions go down. It's a never-ending cycle. So the realization actually came in pieces. It didn't all come at once. It was data that I collected over a period of time. When I'm watching things like Nvidia, Broadcom, some companies I actually really liked all this time, but I was more into income. And I'm watching some of these companies run 200, 300%, whereas some of the ETFs I've got have gone 20%. And then they've been paying distributions, etc. So yeah, this is the biggest pitfall with income ETFs. You are capping your upside for distributions. And don't get me wrong, that can work for people, especially people who want income instead. But when you're 25, 30 years old, I don't think we should be buying these kind of products. I think older people should be buying these products who are close to retirement. So after all that, I started running the maths, and income versus growth it's ridiculous. You are not going to get anywhere near compounded income compared to growth. I didn't actually realise how much growth stocks can go up, because usually a lot of the maths is just on 10% like the S&P, but if you use a systematic framework, you can get a lot more than 10% per year. And I didn't realise how much some stocks went up in a bull market. So this is a systematic framework, rules-based, trend following, the absolute complete opposite to what I've done for the last 2 years, 3 years of investing in income products. Everything went against what I've built for the last 2 years. Growth stocks with no dividends sounded shit. Momentum sounds like day trading, which is just not my thing. But when you do the compounding maths, it starts to persuade you a little bit. And one thing what made me realise is income investing is emotional. And I was using my emotions to buy things thinking I needed cash flow, but I already had cash flow in real life, in my businesses. I didn't need cash flow. So why am I doing this? So then what I needed was a cold mechanical approach to things. And this is what I've done. Look at that. Yorkshire's just beautiful, isn't it? All you Londoners, you want to get to Yorkshire. It's beautiful. I made the pivot. I sold everything, started rebuilding from scratch. I know it's something that I needed to do. And it was pretty scary to start with, because when you sell all your income products, you've got no cash flow coming in, and Usually distributions are what make you money. You can hold an income product and not see any kind of total return until the distributions start coming in. A lot of the psychology was a lot different. It's very hard to get used to. But within the first month, or I'd say 4 to 6 weeks, I've seen a massive change in the portfolio as we're in some kind of bull market now. And the results start showing up pretty fast. So let me show you where I'm at now. We've got Google, 12.5%. I've got Broadcom, 11.1%. That was the biggest high conviction stock. Anyone knows, who's watched my channel knows I'm a high believer in Broadcom. Taiwan Semiconductor, 14.3%. Caterpillar, 15%. This one's done absolutely amazing for me. Nvidia, 12%. And Eli Lilly, which is my best performing stock in the healthcare sector, at 14%. Plus we have a momentum based ETF in there now, which moves from 15 to 20%, because I also put on momentum based trades. Right now I've got Dell on at 4 or 5%. I do take money from my ETF to put trades on. If I see something that's going well in the market right now, I will do that. And semiconductors is a massive part of my portfolio, over 40%, very high conviction. I think semiconductors is going to be around for many years, enough for me to hold conviction and build my wealth around semiconductors and AI and chips and all that sort of crap. So things are clearly working. But the great thing about my portfolio now is I use a systematic approach. So what that means, I have rules, entry rules, exit rules. I've also enhanced my education on macro, so I know exactly what's happening, what kind of cycle we are in. So I'm more convicted in my positions for a start. So if the stock market goes down, I know what's going off, and it just means I buy heavier, I buy more, because I know what's happening. Education is the most important key for any investor. But now here's where I have to be honest with you, because I said I was 100% wrong about high yield ETFs. And that's true for how I was using them. That's not really fair on high yield ETFs, because I still think these can work, and I still think there's room for these in your portfolio, but the way I was using them, I think is totally wrong. And there's one thing about me, I love learning from mistakes. But there's still one high yield ETF that I own, and the split between my portfolio is very small. So right now I own Chippy, which is YieldMax Semiconductor Options Income ETF. It's an absolutely amazing, it's up about 50% on net asset value, and you're getting distributions. It's around 30-40% distributions. It's doing really good. But just bear in mind, semiconductors are doing really good as well. But the split between our portfolio, it is 0.23% of my full portfolio compared to 99.8% growth. So I just bought it to keep the tabs on it. I was slowly buying a couple of shares a week. It's not going to really be a massive allocation in the portfolio. But now you're all going to be like, wait, what? You just spent 10 minutes talking about how bad high yield ETFs are. Well, yes and no, but let me explain. The mistake wasn't income investing. The mistake was 100% income investing at the wrong time in my life. There's no way I should have been doing 100% income products at 29, 28, 30 years old. So during my early years, I was 100% income, had 100% of my capital in high yield vehicles when I should have been compounding them and not giving up growth in them early years. It's so vital. The earlier you start investing, the better off you're going to be when you get older. That's why if you're young, allocate growth. Don't get wrapped up in these high yields like I did, because FOMO is real. And the Think Academy has definitely helped me to see past that. Also remember, put any of the high yield products, any income products inside an ISA. It's all tax free at the moment. My 25-year-old self will probably get seduced by big distributions and yields again, but if there's one thing I want you to take from this video is make sure you match your strategy to your time frame, to what you want in life, and that is going to get you the biggest compounding of your wealth over how many years you've got. Make sure you use the right tax wrappers. Don't just go in emotions and do what feels good. Make sure you've got a strategy and you stick to it. If there's one thing I could go back and tell my younger self, it would be the years between 20 and 40 are your compounding years. Every pound you invest now is going to be 10 in the future. So use them years wisely. Leverage the biggest asset you've got, and that is time. Remember this phrase, growth compounds, distributions distribute. One builds and one gives out. So make sure, if you're in your growth phase, make sure you're building. That stage in your journey and you're chasing yield, I totally get it. That used to be me. It used to feel productive. It used to feel like you're stacking, you're compounding. Growth is the way. You really need to compound growth if you are looking to build your wealth. Growth is the way. One thing I would say is run the numbers and you will be very surprised. So I'm going to document a lot of the framework on this channel. Probably going to be posting one video a week. If it sounds useful to you, make sure you subscribe. Drop us a comment. None of this is financial advice. I'm just documenting my own journey towards financial freedom. What works for me might not work for you. So always do your own research. And if you enjoyed, tune in for the next one. Thank you guys. See you later.